Portfolio Construction and Risk Management, Chapter 11, Defensive Portfolio Strategies. Section 2, Defensive Sectors. A sector is considered defensive when people and businesses keep paying for its products even as the economy slows. Because the spending is tied to everyday essentials, demand, revenue, and earnings usually hold steadier than they do in more economically sensitive areas. The classic defensive sectors are consumer staples, healthcare, utilities, and often telecommunications. What they share is pretty simple. They provide things people rely on in daily life, so demand tends to be more stable across good times and bad. The main difference between defensive and cyclical sectors is how much demand changes with the economy. Households may delay a vacation or a new car, but they usually keep buying groceries, medicine, electricity, and phone service. That steadier demand can translate into steadier sales, cash flow, and sometimes more reliable dividends. In downturns, investors often value that resilience, which is why defensive stocks may fall less than the broader market. But resilient does not mean immune. Defensive sectors can still decline in bear markets. The goal is usually to lose less, not avoid losses entirely, and those smaller drawdowns can make recovery much easier. A good example came during the 2008 financial crisis. The S&P 500 fell roughly 38%, while consumer staples dropped about 20%. So both lost value, but the defensive sector provided a meaningful cushion. If you want a defensive tilt, the idea is to shift part of your stock exposure towards sectors with steadier demand and reduce some exposure to more cyclical areas. That can be done with sector ETFs or individual companies, with extra attention to balance sheet strength, cash flow, and periodic rebalancing. For instance, imagine a portfolio that starts heavily concentrated in the S&P 500 and technology. Moving a portion into staples, healthcare, and utilities can lower drawdown risk while keeping you invested in equities rather than moving completely out of the market. Still, defensive sectors are only one risk management tool. They can become expensive. They carry their own sector-specific risks, and they may trail more cyclical areas when the economy starts to recover. The biggest mistakes are treating all defensive sectors as interchangeable, concentrating too much in one area, or ignoring valuation because something feels safer. Defensive positioning works best when it supports a broader plan that also includes diversification, position sizing, and disciplined rebalancing.